Hi, everyone, and thank you for joining us for today's webcast, Why Invest in Workforce Housing, sponsored by Pinnacle Partners in partnership with JPI. Today's webcast will provide one CFP, one IWI, and one CFA CE credit. If you have questions on credit, please give us a call via the number on the console. We welcome and encourage your questions. You can type your questions in the Q&A box, and we'll do our best to get to as many of your questions as possible. Materials have been made available for download from the Documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey that is also located at the bottom of the console. We will cover quite a bit of information during today's webcast. If at any point in time you are interested in scheduling a one-on-one meeting with Pinnacle Partners, please click the blue Confirm button in the meeting request box on your screen. And lastly, in the event you missed any part of today's webcast or simply would like to watch it again, a replay will be made available and all registrants will receive that information by email. On today's webcast, we will be covering first about Pinnacle Partners and JPI, Pinnacle and JPI Workforce Housing Fund. We will then go over why workforce housing, the macroeconomic overview, opportunities with technology, and then project summaries. I would like to go ahead and introduce our speakers today. So we have Paal Kibsgaard, is the former chairman and CEO, Schlumberger, driving bold transformation across JPI, leveraging over 28 years of global executive leadership and operational experience to insource and integrate the real estate project lifecycle, optimize and digitally enable workflows, and redefine site operations through advanced process engineering, creating a highly scalable and differentiated platform. Mollie Fadule is Chief Financial and Investment Officer at JPI, where she oversees investments, capital markets, finance, legal, and technology, driving the company's success as a premier developer and builder with over 120,000 units across the U.S. And finally, Jeff Feinstein is a founder and managing partner of Pinnacle Partners, where he leads investor relations and operations management, and Jeff is co-managing member of the general partner. And before I turn it over, I want to introduce the firms. So JPI is a development and construction company bringing over 34 years of expertise in Class A multifamily housing, having built over 115,000 homes representing $25 billion in value across the U.S. With a mission to transform building, enhance communities, and improve lives, JPI leverages a vertically integrated platform to deliver best-in-class multifamily projects across the income spectrum. And Pinnacle Partners is an SEC-registered investment advisor focused on tax-advantaged private real estate investment opportunities, specifically through qualified opportunity zones and workforce housing developments in partnership with 50-plus RIAs and hundreds of individual investors. The firm has capitalized over $100 billion in multifamily development projects, including over 900 units of workforce housing. And Pinnacle sources off-market opportunities with best-in-class development partners. So with that, I would like to go ahead and turn it over to our first speaker, Jeff. So welcome, Jeff. The floor is yours.
Thank you, Natalie. Hello, everyone, and thank you for joining us today. It's particularly timely for us to host this webinar at this point in time, post-election, before year-end, just before year-end, and indeed today is a Fed day, as we might, or we hope to anticipate a reduction in rates. So we're going to speak to you today about our hypothesis, supposition that there's real alpha to be gained in investing in real estate at this time in the cycle. And in particular, we're going to focus on what we consider matters most in real estate at this time, and that's delivering affordable housing units. We're excited to announce and launch effectively on this forum a new venture between JPI and Pinnacle Partners. We're focused on deploying an identified fund of 5 workforce housing projects in dynamic markets. We'll discuss that later in the presentation. We'll invest well over $200 million of equity into this fund, and we believe we're addressing critical housing challenges and shortages, at the same time providing investors an opportunity to earn a very attractive rate of return. So before we dive into the details, Natalie did a good job on the table of contents, but today what you're going to hear, we take our hypothesis, there's real alpha in real estate at this time in the cycle, We're going to speak about why workforce housing is the most compelling asset class across the real estate industry. We'll use macroeconomic information to support our hypothesis. And then we'll speak at length, because it's vitally important to understand JPI's capabilities, a best-in-class developer who's enabled with technology, as Paul will describe, that really allows them to deliver and execute on construction and development better than most. Now, we've chosen this venue, the RIA Channel, very specifically because we've observed as an opportunity to announce our new fund and launch this new fund, because we've observed an increasing demand for alternative investments, particularly in real estate. So a recent report, which is reflected here on the screen from Mercer, underscores this point. So what we see here, and we'll look to corroborate this in a poll question momentarily, is 92% of financial advisors are allocating alternative investments on behalf of their clients' portfolio. 91% of the financial advisors intend to increase allocation to alternatives across their clients' portfolio, and 85% already allocate to real estate. So this suggests that there's a growing momentum and interest and attractiveness to alternatives, clearly, and very specifically real estate. So let's try to corroborate that, if we can, Natalie, with our first poll question.
Absolutely. And that first poll question reads, which of these alternative investment asset classes are your clients most interested in increasing their exposure to in 2025? And you can select your answer choice by clicking directly on the screen and press submit between A, private debt, B, private equity, C, cryptocurrency, D, real estate, E, impact, or F, hedge funds. Again, that question reads, which of these alternative investment asset classes are your clients most interested in increasing their exposure to in 2025? And again, you can select your answer choice directly on the screen and press submit. We'll give you another moment here to submit your answer choice, and then we'll take a look at the results. So you can choose between private debt, private equity, cryptocurrency, real estate, impact, or hedge funds. Looks like we're getting a good amount of results here. We'll just give it another moment. Alrighty, so let's go ahead and take a look. So looks like the majority, Jeff, are saying private equity, followed closely by private debt. So what are your thoughts on these results?
In real estate at 19.6. So yeah, that's good. Crypto, you could argue is at the top, so that's appropriate. That's good. Good results. Corroborate our point of view. Thank you. And we have one more poll question.
Wonderful. And that question reads, and should be showing on your screen now, what percentage of advisors use alternative investments? Is it A, 50%, B, 75%, C, 92%, or D, 95%? And again, that question reads, what percentage of advisors use alternative investments? And you can select your answer choice directly on the screen and press submit between A, 50%, B, 75%, C, 92%, or D, 95%. We'll give you another moment here. And just as a reminder, if you have any questions for our speakers today, you can submit those in the Q&A box, and we'll get to as many of your questions as possible. We'll give it just another moment here, and then we'll go ahead and take a look at these results. Alrighty. So, looks like the majority are saying 50%. So I'll turn it back over to you, Jeff.
Excellent. So that, again, this corroborates the Mercer poll. Once again, this is why we are here today to launch our fund very specifically to the RIA community. Now, we at Pinnacle Partners, we've deployed 13 AIFs. We call these are the funds which access institutional quality assets, in our case, real estate, and very specifically, the Workforce Housing Fund will be a fund of 5 high-quality projects in dynamic markets. What we do is we put the belt and suspenders around the fund. We provide the custody relationships that every RIA needs, the audit capabilities, and a very deep partnership, in this case with JPI. So we've turned this crank multiple times, and the benefit to your clients is we're delivering alternatives, institutional quality alternatives to you, the RA. You could be a singular practitioner, or you could be managing billions of dollars of AUM. We've derived and leveraged over 50 such RIA relationships over our, the $1 billion+ of capitalized projects that Pinnacle has led. So we'd like to say this is designed for RIAs very specifically, and you'll get the benefit of complete transparency, full due diligence and data rooms, again, the custody partnerships, and then all the other investor relations required so that you can offer this confidently to your client base. Go to the next slide here. And so we are very, very pleased, as I said just a moment ago, to be partnering with JPI. JPI in 2023 was a top 10 developer nationwide. They have particular capabilities that are unique to them and I think differentiate them across the industry. And they can deploy on this fund of 5 workforce housing projects better than most. So let me introduce Mollie Fadule, a leader and partner at JPI, a senior executive who will give you more information about JPI's history. And then later we'll talk about the technology enablement that allows them to execute better than most. Mollie?
Thanks, Jeff. Hello, I'm Mollie Fadule. I'm the CFO and CIO at JPI. We're a 4-year-old development and construction business that has been building multifamily throughout our entire lifespan. We've built projects in 143 cities, representing 348 communities, which holds 117,000 homes and a market value of $26 billion. So we do have significant experience in building homes up and down the income spectrum. We do develop low-income tax credit homes where those with less than 50% of median area income can live. We develop middle-income housing, workforce housing is another name for that, which covers individuals that are earning anywhere from 50 to 150% of AMI depending on where they live. And then we build market rate housing, which is not income restricted. For 34 years, we've been an integrated GC and development business, which has provided very attractive returns for our investors. Over our life, we have provided returns of 19% IRR on our projects. As we talk about our current projects that we have ongoing today, there's quite a few. In December of this year, right now, we have 27 communities under construction, which represents 9,174 homes. And then we have 11,204 homes that are in our development pipeline that we control, which represents value of over $3.6 billion. We're very disciplined in our approach in terms of how we think about opportunities for us to take on. We cover the entire development life cycle of our projects, all the way from searching to find land sites through the design, development, time. We also have an asset management team that helps maximize the value of our property before they are sold. One of the differentiating factors that we have compared to any of our peers is the integration that we have across project level. So we, as I mentioned, have our own land acquisitions team. We look at over 800 properties annually. We submit offers on roughly 100 to 150 properties a year in order to move forward on between 12 and 15 projects in any given year. Our development team helps us also source land, as well as coordinate the design, entitlement, and project approval processes, which, as you may know, are difficult, which is part of the reason why our country faces such a large housing crisis. We do in-house design that allows us to enable some of the technology that Paul will talk to you about, as well as to move quicker throughout the design period and help us around standardization of unit sizes and layouts, which can help in the construction schedule, both from a time and cost standpoint. We have our own general contracting business. So we as general contractors coordinate with the subcontracting trades to bring the building through the full construction process. We are highly focused on safety and quality, and on a daily basis, we monitor our schedule and costs and have performed very well from our general contracting business. From a project capitalization standpoint, we have a number of bank relationships that provide us with senior construction loans. We also have relationships with a number of institutional equity groups, as well as high net worth investors and family offices. And our investment management team helps us think about ways in which we can maximize property value, lease up our properties as quickly as possible, and we monitor our property performance in light of market data to ensure that we're performing in the top quartile against our peers. It's really important for us to help you understand what our purpose is. So yes, we build housing, we build a lot of it, but really what we're seeking to do is transform building, enhance communities, and improve lives. There's a number of multifamily developers throughout the U.S. that are focused on building housing, but we think we approach it in a different way. From a transforming building perspective, we're looking to revolutionize cost and
Sorry, we're having a little bit of a hard time hearing you. Do you mind dialing in as well, just to make sure that we're hearing you to the full extent?
Sure, I'm happy to do that.
Wonderful, thank you. And just while you are doing that, just as a reminder for our audience, if you have any questions for our speakers, you can submit those in the Q&A box, and we'll do our best to get to as many of your questions as possible. And also, materials have been made available for download in the documents folder at the bottom of your screen. We appreciate your feedback. Please do take a moment to fill out our brief survey as well. That will be located at the bottom of your screen and also populated on your screen after the webcast. We'll give Mollie just a moment to submit and dial in just to make sure that we are hearing her.
Natalie, do you want to take the opportunity to launch one of the poll questions?
Absolutely, and it looks like we might have Mollie back dialed in. Is that correct?
Correct. I just need to turn off my volume in the background here. So there we go. Can you,
Wonderful.
Is that good?
That is very clear. Thank you.
Okay, perfect. So as I was explaining, we are working to transform building, which is a unique differentiating factor about JPI, and Paul can help explain this in a moment. And our goal is to enhance communities through our building. We believe that our well-planned and sustainable building practices can foster strong, vibrant, and inclusive communities. We spend a lot of time thinking about how our common area spaces are laid out in our buildings to enhance the communities for the people that live in our buildings. A number of apartment dwellers do report loneliness. And so we do employ strategies to get our communities to be engaging with one another through barbecues and activities. And that's something that's really important to us, that we are enhancing the communities in which our residents are living. And then lastly, improving lives. So it's our view that we can create opportunities and positive outcomes for our associates, those that work at JPI, our investors, our partners, and our residents. We look at our impact based on the number of lives that we can touch in any given year, and we estimate that to be in the tens of thousands of dollars in 2024, or of people in 2024. Well, JPI is a 34-year-old business. We were privately owned up until last year when a public company based in Japan took a majority stake in our business. This was a transformative milestone for JPI. Sumitomo Forestry is the company. As I mentioned, they're listed on the Tokyo Stock Exchange. They acquired our operating platform, our pre-development, our land, and our pipeline. As we're pursuing developments in any given year, we have a significant balance sheet investment, a lot of capital put towards our pre-development and land. And Sumitomo Forestry has provided significant capital for us to continue to grow our business and invest in new projects. We have hundreds of millions of land under control and on our balance sheet, and Sumitomo Forestry continues to support our investments in land and pre-development, which is important because a number of multifamily developers do not have that capital backing. And as we look at this fund and other opportunities that we underwrite, we do not raise capital from third-party investors until our projects are actually ready to break ground. So there's a significant amount of risk that comes with development in the early stages when you're buying land and going through entitlement and permitting process. But in the case of JPI and this fund, we mitigate that risk. And as we raise third-party dollars, it's into a project that is ready to break ground with a construction budget that is set. While Sumitomo owns the majority of JPI, myself and our CEO, Peyton Mays, own a minority portion in the business. And Peyton and I have a history of working together almost 20 years. And JPI and Sumitomo Forestry have known each other for 10 years. So while this acquisition by Sumitomo was just a year ago, we do have a long-term relationship, and it's allowed us to continue to grow and expand our business and invest in technology to help support the goals that we have in impacting housing in America. I'll now talk about the workforce housing fund that Pinnacle and JPI are launching together. So we are very excited to announce that we have formed a fund to invest over $200 million of equity in workforce housing. We believe this partnership creates a unique opportunity to address the critical workforce housing shortage that Jeff mentioned. There's a number of estimates around how many houses we are short in the United States, anywhere from as low as 3 million to as many as 10 million homes. As you all know, it's been a massive policy issue in Washington, D.C. on both sides of the aisle, and we are hoping to be able to have an impact on solving this issue by developing more housing. This fund represents a diversified portfolio of projects that are in the affordable workforce housing space, and it's structured as an alternative investment fund of identified projects. Why workforce housing? Workforce housing is a different category of housing than market rate or single family for sale housing, and I'm going to explain that right now. So many households have incomes above levels that are usually targeted as affordable housing. So there are government support programs for those that are on the low income spectrum in the U.S. that provides housing vouchers and support for those that are unable to find housing. But there's this missing middle, many call it, which falls into the category of workforce or middle income housing, where there's a lack of housing supply for those that are in that income bracket. And that's been a huge challenge for many Americans, particularly as construction costs and rents have increased significantly over the past 10 years and throughout COVID, with significant inflation impacting both costs as well as rents as limited supply has come to the market. So workforce housing can be defined by area median income, which is basically the average income of families living in certain regions designated by zip codes. And workforce housing typically targets folks in the 50 or 60% up to 100% of area median income. Now, this isn't a perfect science because you do have markets where there are individuals earning more than 100% of AMI that cannot afford to buy homes in the markets that they're in. So we include in the definition, as well as many others, that workforce housing includes housing for individuals or families in markets where median home prices and mortgage payments significantly exceed rental costs for apartments. And we calculate this based on how much does it cost to buy a home in a submarket with current mortgage rates versus how much does it cost to rent an apartment in that same market. This housing is really intended for essential workers, such as teachers, nurses, police officers, and retail workers. And our goal is for this housing to be based in reasonable proximity to workplaces. As housing has become more and more expensive, a lot of these essential workers that work in communities are unable to live in the communities in which they work, and this has a negative impact on them and their families. So workforce housing really is focused on trying to locate these workers within the markets that they work at an affordable rate that they can afford according to their income. Workforce housing projects are defined as all or a proportion of the units are leased to low to middle income workers, and it's housing for renters that may not qualify for otherwise income-restricted housing but still face challenges of affording home ownership. And this is focused on providing high-quality housing options at rental prices that are significantly below the cost of home ownership and are rent-restricted. So rents are actually calculated on the affordable units as a percentage of AMI, and those rents cannot go up more than inflation in any given year as reported by the HUD. There are a number of reasons why we think that workforce housing is an attractive investment opportunity, and I'll go through these here. Firstly, there's significantly strong and very stable demand for workforce housing. It caters to middle-income renters who are underserved in the market, and this creates consistent demand and strong occupancies in workforce housing projects. There's very favorable market dynamics right now in the U.S. for workforce housing, with rising home prices, high mortgage rates, limited new supply. There is an affordable housing crisis, which makes this investment resilient and very high in demand. Workforce housing projects generally do lease up faster than market rate housing because those that are looking for income restricted rents sometimes have to sign up early and on lists, and sometimes you can't actually process as many tenants as may want to rent in a rent restricted market. So that just creates more demand than a typical market rate project. They also provide attractive investment returns. Workforce housing offers a stable cash flow, and there are also potential tax incentives compared to market rate multifamily developments, and I can share some information about some of those in a moment. There's a positive social impact, so investing in workforce housing helps address the housing affordability crisis. It helps support essential workers and promotes community stability. And then long-term resilience. Over the long term, workforce housing benefits from a broad renter base with strong economic fundamentals and has proven to be durable through market cycles. We'll now go to a poll question.
Yes, thank you, Molly. And that polling question reads, has your firm allocated client capital to workforce housing developments in the past, and are you interested in workforce housing funds for 2025? And you can select your answer choice directly on the screen and press submit between A, yes, our firm has allocated client capital to workforce housing developments, and yes, I'm interested in workforce housing funds for 2025. B, yes, our firm has allocated client capital to workforce housing developments, but no, not interested in 2025. C, no, our firm has not, but interested in workforce housing funds for 2025. Or D, neither allocated nor interested. And you can select your answer choice directly on the screen and press submit. We'll give you another moment here to submit your answer choice, and then we'll take a look at the results. So again, that question reads, has your firm allocated client capital to workforce housing developments in the past? And are you interested in workforce housing funds for 2025? And just as a reminder, additional material can be found in the documents folder at the bottom of your screen. And when we do get to Q&A, we will definitely try to get to as many of your questions as possible. So please continue to submit questions in the Q&A box underneath the slide window. So it looks like we have some good results here. All right, so we can go ahead and move on to the results. So let's go ahead and see. They have not, looks like majority have not, but they are interested in workforce housing funds for 2025. So Molly, I'll turn it back over to you.
Thank you. And really, workforce housing as a class of investment is really relatively new. So I'm not surprised that many of you have not invested but are interested in workforce housing. It is a new definitional sector of housing, and we're excited to be able to play a part in it. So I wanted to explain some local and federal government support for workforce housing. First, I would like to say that Scott Turner, who is our Chief Visionary Officer at JPI, has been selected by President Trump to go through the confirmation process for Secretary of HUD. We are excited for Scott for this position that he can take on. Both parties had presented candidates that had large plans for housing, and we know that Scott is supportive of continuing to help support affordable housing in America, hopefully in his role, if confirmed, as Secretary of the HUD. So wanted to mention that, and we're proud that JPI has been able to play a role in his career as he'll now be moving on to serve our country and no longer be with JPI. But there is local and federal government support for workforce housing. There are tax incentives, there are property tax exemptions in some cases, and tax credits that can help reduce operating costs when a property is operational after it has been built. There are also tax incentives sometimes through the building process, and it really is jurisdictional in nature, but in some cases sales tax can be avoided for workforce housing funds. In addition, there is favorable financing that can be attracted to workforce housing projects. There is access to lower cost debt. Sometimes tax-exempt bonds can be used for financing, and government-backed loans can help reduce borrowing costs. In addition, there's a number of large banks that have shown interest in the social impact that investing in workforce housing can have, and they do offer more favorable terms than for market rate housing if there is a demonstrated social benefit of a workforce housing multifamily project. In addition, there can be entitlement and permitting impacts. There are density bonuses, which means in some cases, if you're building workforce housing, you can build more units than you otherwise could with a market rate project. And there also sometimes are reduced impact fees, which is a large portion of housing, particularly in markets on the coast. And sometimes you can receive expedited permits for workforce housing projects. Some workforce housing projects are public-private partnerships where you can enter into joint ventures with government entities, which can both help reduce risk and can improve financial performance for the investment. And this can be with housing finance corporations or public facility corporations or other nonprofits or government entities. And then finally, for the HUD, support from the Department of Housing and Urban Development, such as rental assistance programs, housing vouchers, and affordable housing grants can help stabilize tenant demand and provide income streams for multifamily projects with workforce or affordable units. So this is really important to call out some of the benefits that can come to workforce housing projects that are unique. I'm having trouble advancing the slide. Could you please advance the slide? Thank you. Now I'd like to talk about the macroeconomic overview environment that we're in today in an overview. I did just hear that the Fed lowered rates by a quarter point, so that was good to hear. But if we look at interest rates, could you advance to the next slide, please? If we look at what's happened with interest rates, it can help us think about where we are currently in the real estate cycle. So we had a 500 basis point increase in interest rates since the cycle low in 2020. And there was pretty significant volume of multifamily starts throughout that low interest rate environment from, say, 2016 through 2022. But as interest rates went up, we saw sales volumes significantly decrease. We also saw multifamily starts decrease significantly, and really a risk-off environment, which led to significantly fewer investments in in multifamily, both workforce and market rate. So this cycle, we think, has passed its bottom as interest rates peaked and have now started to come down. We are seeing more activity in multifamily housing, but because it's a cyclical business, we can show you some information about how sales volume and starts have moved recently and why we think it's a good time to be investing in workforce housing. So as we look at multifamily sales volume, you can see it was pretty consistent from 2017 to 2019, growing a little bit. And then in 2020, you had a bit of a blip due to COVID-related impact on market and transactions. A lot of things went on hold for quite a few months. But then in 2021 and 2022, in a very low interest rate environment, we saw significant volumes of multifamily trades. That reduced significantly in 2023 and 2024 as interest rates went up. So as borrowing costs went up, there was not nearly as much investment in multifamily housing because it was more expensive to finance. Now, as interest rates have started to come down, we have seen volumes start to recover in the last part of this year. We expect that that will continue going forward. And similarly to multifamily sales, we've seen multifamily starts go down significantly as well. And actually, multifamily starts are not even forecast to get back to our average levels of the low interest rate environment that we saw in 21 and 22 through this next cycle. So increased interest rates and tightening lending standards and also rising construction costs with inflation led to significantly less new starts on the multifamily side. So you can see in 2022, we reached 500,000 multifamily starts. In 2023, that was slightly down, but it was still 450,000 starts. In 2024, we are at roughly 300,000 starts, which is significantly below this peak, as well as below the average of 350,000 starts that we saw from the 2016 to 2020 period. And so what this means is that less supply is coming into the market, which creates an even bigger problem for those that are trying to find apartments to rent at an affordable pace. It's really a supply and demand dynamic. To the extent that there is significant new supply in the market, rents are either not growing as much, or there's not as much pressure to grow, or they're flat to down. If markets have significant new supply, in some cases, rents for the ultimate homeowners can go down. But in environments where we don't see much new supply coming and where the demand for housing outpaces supply, we see significant increase in housing costs, which is a problem for middle-income renters. So when we look towards we know what happened in 2024. We're almost closed out on this year, and we were significantly down on start volumes, and that's continued to, that trend is expected to continue per the forecast from Witten Advisors in 2025 and 2026, which means that there will not be as many new deliveries coming to market in the 2027 and 2028 time period, which means that it will be more difficult for people to find housing. It's forecast that occupancies will go up and rents will grow throughout that time period due to the lack of new supply and supply not keeping up with the significant demand for housing in our country. So that sets kind of the stage for where we think we are right now in the cycle. There was a significant amount of investment in building and real estate, which really reduced as interest rates went up, and now the interest rates have started to come down. We are seeing a little bit more activity, but right now there is little activity compared to the highs in start volumes, which we think is a good time to enter into the market, because projects that are starting today will be delivering into a much lower supplied environment, which should mean that demand will be very strong for new projects. So in light of the macroeconomic opportunity that we think is attractive right now, we'd also like to talk about some of the opportunities that we see with technology. JPI has invested over $10 million in technology over the last 3 years in order to help improve our execution capabilities and work towards cost and schedule reductions in our projects. So it's our belief that there's a significant opportunity to leverage technology across the development and construction industry. In the top left graph, you'll see that real estate is the largest industry as a percentage of GDP at 13%. If you look in the bottom right-hand quadrant of the image, you'll see that the adoption of digital technology, construction is number 21. So despite being such a large portion of GDP, you've seen very, very little adoption and investment in technology. Construction is highly fragmented, particularly on the multifamily side, and you don't have a lot of players having the capital support to be able to invest in technology and adopt technology. And so the sector is really lagging, and this has led to an impact that has hurt middle-income renters in America because costs have gone up. So if we look at the upper right-hand graph, you could see that from a manufacturing standpoint, we've become more efficient in manufacturing goods. Things like cars in today's dollars are cheaper on a purchasing power adjusted basis than they were in the past. Unfortunately, buildings have not seen that. The building costs have gone up significantly. We have actually seen a reduction in productivity, which you can see on the lower left side of the image, that labor productivity trends have gone actually down in construction over time, whereas you could see on the graph that manufacturing productivity has gone up significantly, and that's been enabled by technology. So JPI is very happy to have a partnership with Paal Kibsgaard, who I'll introduce right now, that has helped us think about the ways that we can use technology throughout the development and construction cycle to improve our property performance and have a sustained competitive advantage in the market, and to provide more housing so that more renters will have access to high-quality housing in the U.S. So Paul, I'll let you take it from here.
All right. Thank you, Mollie. Good afternoon, everyone. So just building on what Mollie was saying around the opportunity for applying technology within the multifamily space, I consider the opportunity huge. I mean, if you look at some of the data that Mollie just presented, I think it's fair to say that we are facing significant stagnation in terms of driving the technical performance of projects forward within the multifamily space. And there's a lot of reasons for that, but I would say the predominant one is the enormous fragmentation we have of the capability set that is required to put together a multifamily building. And if you build a 300-unit building, it's a fairly significant undertaking in terms of both time, man hours, all the parts, as well all the different technical capabilities that you got to bring together and layer it in, right? And today it is a very much everyone serves themselves type of an approach, mainly because of the fragmentation. When you have 30, 40, 50 commercial interests participating in a highly complex project, and each individual entity is going to focus on themselves rather than being aligned to focus on the project. So as you look to apply technology, it is not only about finding the technologies and then going ahead. You also got to look at the structure of the company as well as the project to make sure that what you invest in and what you apply can actually translate into bottom line impact for the developer and then equally to the project. So what we've done at JPI, over the past, I would say 12 to 18 months, is that we have continued to insource a larger part of the value chain. Traditionally, JPI has always been an integrated developer and GC, but the approach of the GC has been very much in line with the industry, which means not realizing any of the, I would say, performance upside that is there to be taken. What we have done over the past 18 months is we have also insourced design. So we now do our own designs of the buildings. And that's important to make sure that we get the alignment and the completion and the accuracy of the documentation, both to expedite the permitting process, but even more so giving the construction trades all the information they need to be effective at putting the building together. In addition to this, we have also insourced some of the trades, and we're in the process of ramping that up. in particular framing, and then most of the internal finishes we have also insourced. And the reason for this is that when you invest in enhanced planning and you put more effort into making complete plans, more accurate plans, that is going to facilitate quicker construction. If you don't have, I would say, a participation in the trades, then it's actually the trades that are going to run away with all the benefits of the investments that you make as a developer. And this is what we have done again over the past 12 to 18 months. And I think the reason why the industry doesn't do this is that can be a pretty heavy lift. The advantage we have, in addition to myself, who has extensive oilfield services background, which is very similar to the backgrounds that are required to I would say, organize and run big scale projects like a multifamily development. I also have another 3-4 people from Schlumberger with me in the team. And the workforce we had in the oil field, I mean, at the peak at Schlumberger, we had 150,000 people, which we managed. And obviously, we're not talking about the same amount here, but it's a significant undertaking that we now master as well, probably as a unique company in the multifamily space. So that's the background. So we control a lot more of the value chain. And with that, we can invest much more into the planning and then drive the value of that additional and enhanced planning into the site operations. So very quickly, how do we go about this then? I would say the fundamental part of what we do is that we build 3D Revit models for everything that we build. Because we use that to streamline and automate both the design process as well as the planning process. And we also use these models in the actual operations. So the way we're going about this is rather than having a very bespoke approach to design, where typically the industry will start over from scratch for any kind of project that is being undertaken. And with that, never really finishing each project, I would say we get up to sort of 60-70% complete in terms of the actual accuracy of the plans that the industry is producing. What we have done is we have taken for the various building products, and what you see here is a wrap. We have basically gone back and looked at the last 10-15 projects that JPI has done. And we are looking to basically breaking our buildings into sub-buildings and basically creating Lego pieces of these, which then has a certain size and perimeter, as well as a different unit mix. So what you see on the slide here are different units, 1, 2, and 3 bedrooms. And when we then get to a site, we can then play around with these individual Lego pieces to get the building positioning and perimeter on the unique site, and by picking different type of either corners, ends, and middles here, we can then also adjust what the average unit size is for the development. So with this, we build out each of these 14 modules to a complete LOD 350, which is fully VDC optimized, which means that there are no surprises when we go ahead and execute. So we do that once for each of these 14 models that we have in the library. And then when we then have figured out how to position and the extent of the building by picking these individual modules, we then splice everything together, which is very quick. And then we are almost ready to go for permitting, in a very limited amount of time. So the kit of parts, standardization, building sub-models in terms of 3D modeling, that's the starting point for doing this. And then we invest heavily into these modules once, and then we just reuse them in different configuration from project to project. So then the next step is when we have then designed these models, we can then also, within the Revit software, we can populate them with a significant amount of data, which we can then use to streamline the planning. If you can advance the slide. We can significantly, accelerate the time to both permitting and also having documentation for our pre-construction planning department to go out to bid a lot quicker as well. So the way these Revit models are structured, you have all the kind of the main sub-model components here, framing, siding, roofing, and so forth. And what the system actually allows you to do is to input a lot of information for each of these subfamilies, which you can then script, and you can then basically produce reports or drawings that are fully basically annotated, so that the time and I would say the labor required to get to permit drawings or to construction drawings, we can automate that to a large extent and significantly improve the time and the cost in order to get to those stages for the project. So really accelerating the upfront planning and getting to the point where we can get both entitlements and permits as well as bidding. So this is a significant improvement in the speed that we get to go forward with the project, but it also provides significantly more accuracy in the plans that we provide to both the GC part of the company and the trades. If you go to the next one. So just to show you a little bit more about these automated planning workflows, just click the forward. You see here the 3D Revit model, which I just explained. That helps us streamline bidding, permits, for sure. And we can also then input these Revit models into our pre-construction planning software, and we use Destiny. And again, this helps us getting very accurate cost estimates. We don't need to do manual takeoffs anymore. We can actually run a report on the spliced Revit model with each of the sub-elements in it, and then get a very accurate, bill of materials for the project. And that significantly reduces the variations and the misestimations of material, which is a significant part of the project cost. And we then link that into our supply chain and lead times and so forth to make sure that we have all the material we need at any given time to make sure that the project doesn't stop because of shortages. The other thing, please go back. The other thing we can do as well is we can use these models for quality control and progress tracking. What we do is during the early part of the projects, we run drones on a daily basis, which then gives us the footage of, for instance, the everything that's going to have to happen with utilities and the subsurface and any kind of structural things around, the concrete or the columns and so forth, making sure that everything is placed. So we run the footage on this by the end of the day. We upload it to the cloud, and we have a team in India that actually overlays this with the actual 3D model itself. And if there are any deviations, we will have that report back in the morning, and we can then correct it. Similarly, when we are in the building, we also run cameras around either each day or every second day, and we can do the similar type of overlay between the actual footage and what the model says, which means we have a very accurate view on progress. And we also have a very good way of quality controlling what we do, which means that we don't have to stop and redo things. We can correct things along the way if there's a need to correct anything. So then with all of this, if you go forward. With all of this, then it's a matter how you then bring this together, at the site. And I think, as you all know, construction is a manufacturing process. It doesn't allow you to do exactly the same thing as what you can do in a factory, but you can organize yourself in a much better way than the industry does today if you have better plans and if you can get alignment between the GC and all the trades towards executing in a way that speeds up the projects, reduces the cost, and takes a lot of the uncertainty and the risk away linked to schedule and time. Go to the next slide. And just a quick summary on how we are going about this. We have then looked at the building and taken a very granular view of what are the components and the elements that needs to go into it in order for us to complete it and to assemble it in a very effective way. And we've come up with, in the range of 180 different layers. And it's almost thinking about this as 3D printing. So there is a sequence to things. Obviously, you've got to do the foundation and the concrete before you do the framing, and so forth and so on. And on the framing, you need to do the walls, the trusses, and then the decking, and you repeat that for each floor. So by looking at this and defining what each of these layers are with respect to the prerequisites, what you need to have in place in order to be able to do this one particular layer. And then also leveling everything out where we need each layer to actually take an equal amount of time. Because if you think about the assembly line in a factory, the product moves forward on a certain pace, which is the tact of the manufacturing operation. And what happens on each station is timed so that it takes exactly the same time. So this is what we are doing now. We are assigning resources and labor to each of these layers to make sure that they do take the exact same time. And then we can layer in and move everything forward a lot quicker, to the point that if you look at each of the units, say in a 300 unit development, If you go with a conventional schedule, you are probably in each unit about 15% of the time, which means 1.5 days out of 10 work days. So in that, you have a significant amount of time where that particular unit isn't moved towards its completion, and that basically puts a drag on the schedule. With the way we are organizing, which is a lot tighter, we can significantly improve that 15%, which means that we are in the units a lot more frequently, and that obviously helps advance us towards completion of the building a lot quicker. And in this kind of setting, time is money, and time is also helping reduce risk. If you can get in and out of a project a lot quicker, that reduces risks around weather and all sorts of things as well. So this is the approach that we're taking, and it's a very interesting, I would say, journey to be part of. There's so much upside, within this industry, and it's not all about digital technologies and this and that and the other. It's actually a lot about how you organize the people, how do you incentivize the people, and how you create the alignment with every participant towards actually producing a project that is done quicker and at a lower cost. And that's what we focused in on. Handing it back.
Thanks, Paul. So there's not a lot of former NYSE-listed public company CEOs working in multifamily, but JPI is very happy to have Paul working with us on implementing some of the technology that they've used in the oil field to help us build multifamily housing to provide more housing for more Americans. And it's our view that we can deliver faster and more cost-efficient projects, which is both good for the residents as well as for our investors. So as we look to the Workforce Housing Fund, we do have a summary here, and I'll go through the high-level summary, and then we can open it up for questions. But we have identified 4 projects from our pipeline. We worked together with Pinnacle, opened up our entire pipeline to them, and we identified the projects that they felt fit our pipeline best, which includes 2 projects in Texas, one in McKinney, 393 units with a total project cost of $104 million, one in Denton. These are both in Dallas-Fort Worth area. 415 units, $108 million. In Oceanside, California, 295 units, $150 million in project costs. Things in California do cost more. And we also have an identified project in Redmond, Washington, that's 224 units, $103 million in total cost. These projects range from 50 to over 200 units of affordable housing per project. And those are marked at a variety of levels of AMI, anywhere from 50 to 100% of AMI. And in all cases, the rent at our projects is significantly below the cost of owning a home in any of these markets. So now we'd like to open up for questions that anyone has about the fund or the technology that we're using or any of the specific questions around the projects.
Wonderful. And thank you all for such an informative discussion. Just as a reminder, additional material can be found in the documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to take our brief survey that is also located at the bottom of your screen. Our speakers will be taking advisor questions. Please type your questions in the Q&A box and we'll get to as many of your questions as possible. In the event your question is not answered on today's webcast, a member of the Pinnacle Partners team will reach out to you directly. And if you would like to have a conversation to further discuss the ideas that were covered on today's event, please click the blue confirm button in the meeting request box on your screen. So with that, let's go ahead and take our first question. So Jeff, it looks like this question is for you. What is the minimum investment amount?
So remember, we are organizing this fund as an alternative investment fund. What we intend to do is aggregate individual investments and arrange potentially either a programmatic partnership with an RIA partner, or it could be a client-driven requirement. Generally speaking, the minimums are around $1 million, but again, on an aggregated basis, if we're dealing with an RIA, we've gone through diligence, we're on platform, so to speak, then we've seen those minimums come down across the firm to $100,000. Hopefully what you all learned during the presentation is that this is a very unique fund. We think the timing is absolutely correct. By the way, we got a 25 basis point reduction while we were speaking. And I was very pleased to see that 53% of the audience, and we got several hundred people here, are interested in learning more about this fund. So I will tell you that, we will engage with the AIF in any way the RA firm or individual would like us to engage, be flexible on minimums, but most importantly, we're prepared to go deep in diligence with you, your IC, or any other third party to evaluate the quality and the underwriting of this fund.
Great, thank you. And the next question, Mollie, has JPI been land banking these projects while rates were rising?
Good question.
Yes, well, these specific projects have come through our pipeline in a variety of ways. The Oceanside, California project was actually signed up in 2018, and it took a significant number of years to get through the entitlement and closing process there. The Texas opportunities have been in the pipeline for quite some time, over a year, and the Redmond opportunities brought through a relationship. And so we're constantly investing in land and pre-development and sourcing deals in off-market ways through strategic relationships and partners, as well as through broker relationships and others.
Great. And Jeff, do you have custody partnerships?
We have pre-existing partnerships with Fidelity and Schwab. We are open to new partnerships, and that'll be driven by the RA partnership that we derive. And so we're very flexible in that category. We've got all the belt and suspenders, as I mentioned earlier, that any RA would require, including audit, and then ultimately these custody partnerships will be prepared and ready.
Great. And Mollie, can you tell us, why did you choose these specific markets?
Sure, happy to. Twice a year, we review the top 50 MSAs in the U.S. We look at a variety of statistics, including job growth, income growth, education levels, developer friendliness, legislation, et cetera. And we rank markets on a weight-adjusted basis, and these markets are at the top of our rankings. All of them fall in the top 10.
Great, thank you. And with that, it looks like we are just a little above the top of the hour. Just as a reminder for our audience, if your question was not answered on today's webcast, a member of the Pinnacle Partners team will reach out to you directly. If you would like to have a conversation to further discuss the ideas that were covered on today's event, please click the blue confirm button in the meeting request box on your screen. And also, we appreciate your feedback. So please submit your survey feedback at the very end of the presentation as well. But I want to thank our speakers for joining us today and for such an informative discussion, and our audience for joining us as well, and hope you enjoy the rest of your day. Thank you for joining us.
Thank you, everyone.